Hello. Thanks for joining me here today. My name is Richard Crowley, and I'm joining you virtually from Singapore. I'm here to present my paper, Executive Tweets, with my co-authors Wenli, Huang, and Hai Lu. So this presentation will go through the details that are in the poster that you have hopefully seen on the AAA website. It'll be a fairly high-level overview of what we're talking about in this project. One thing to note, if you'd like to learn more about this paper than what's covered in this video or in the poster, you'll note that there is a URL here at my website, rmc.link. Do feel free to click through that in the poster if you want to learn more about this project. Up on there, we have a full slide deck for an hour and a half workshop with a lot of details in there. So if you want to really learn about the sort of fine details of the paper, you can take a look at that, and we'll hopefully have a paper up on SSRN soon as well. In this paper, there are 4 things that we're looking into. First, we look at why are executives joining Twitter. All right, so here we're going to look at some characteristics of the firms that the executives work for. We also look at some characteristics of the executives themselves, including personality traits like extroversion. And we'll also bring in what's a bit of an interesting legislation, regulatory rule from the US SEC, that they have this guidance in 2013 that essentially green-lighted the use of social media while simultaneously highlighting the litigation risk behind it through Reg FD. Second, we'll then look to see what it is that executives post about, and we'll also look at whether executives are posting in a discretionary dissemination method or discretionary disclosure style, where they're posting more around certain important corporate events. There's some reason I actually believe that this may not be the case, particularly if you look at this Tobiah and Stephen 2013 paper. They talk about intrinsic versus extrinsic motivation for social media usage, and there, right, you'll find that a lot of people actually are posting more for intrinsic purposes, so things that make them feel good personally, rather than things that are perhaps extrinsically beneficial. Third, we're going to look at market reaction to these tweets by executives. There, we're looking to see whether or not the stock market actually cares about the information that's posted here. Whereas, we all know, of course, that firms are quite active on Twitter these days, and it's quite possible that investors are simply reacting to what the companies are talking about, as opposed to what the managers are talking about. And so we're going to actually check to see whether or not what the managers talk about incrementally impacts the stock market beyond how the firm's tweets are impacting it. Lastly, we're going to look at what the mechanism is for why executive tweets impact the stock market. So there's 2 different mechanisms that are possible. One is, of course, the information story. That would be, of course, that executives are posting new information. The second mechanism is that there is some studies showing that people tend to trust individuals more than they trust, for instance, corporate accounts. Right? So, for instance, this Elliott et al. 2019 paper gets at that. And so there could be a mechanism of trust. In that case, the information doesn't have to be new, but what's important is that it's coming from the manager, not just from the firm. So here you see some results of our first research question. Importantly, we see that litigation risk is a little different for firms that are or for executives that are on Twitter versus those who are not. What we see is that there's a little bit of skewing to the right in the distribution, indicating that higher litigation risk firms, executives, are more likely to be on Twitter. We also see that female executives are much more likely to be on Twitter than their male counterparts. We see that younger executives, as one would expect, are much more likely to be on Twitter, with quite a lot of younger executives being on Twitter, whereas there's very few young executives who are not. And lastly, when we look into personality, we see that extroversion is playing a role. In particular, it seems like those who are more extroverted are more likely to join Twitter. So taken together, right, this shows us that 1, younger executives are more likely to be on Twitter. 2, female executives are more likely to be on Twitter. 3, those with higher litigation risk are more likely to be on Twitter. And 4, more extroverted executives are more likely to be on Twitter. We also did look at the SEC guidance. There, what we find is that there's no main effect, actually. So the guidance did not impact sort of the market or the executives overall in terms of their interest in joining the platform. But for these guys right here with a higher litigation risk, right, so those who are skewed more toward the right, what you see is that it does attenuate their rate of joining Twitter. So before the guidance comes out, they're much more likely to join. Afterwards, they're still more likely to join than other executives, but at a much lower rate. So here we have our second research question. Right, so here we're looking into what executives are tweeting about. We break it into financial, non-financial, business, and other text. In this case, we also are looking around different types of events. On the left, we have external events. On the right, we have internal events. Now, what we see is that for financial tweets posted by executives, they increase with response to all of these different events. However, of course, they do increase much more with the internal events where they can be planned out. The timeline is very clear, right? So, for instance, on the high end for an earnings announcement, what we see is that the executives actually tweet at more than 500% the rate that they usually would. For internal events, we do see, however, there is still some increase, though it ranges from about 7% to 8%. So it's a much smaller reaction, but there is still reaction there. Also, we'll note that for events that are not just financial, but perhaps more broadly important to the firm, so for instance, news articles, press releases, and 8Ks, we see that the reaction isn't just through their financial postings on Twitter, but actually through all their different types of posting on the platform. So next, we look into how stock markets react to managers' tweets. So here, we see that on the day that a financial tweet comes out from a manager's account, there's about a 0.08% change in the stock price. Now, most of the reaction is concentrated on day one. Right, so here what we see is the largest reaction is about 0.25% per tweet. Right, so the magnitude itself is not that large per se. Right, but when there's multiple tweets, it can actually add up into something that impacts the stock price. In fact, across the whole timeline here, we're seeing something that's more like a 0.3 to 0.4% increase in the stock price, or change in the stock price. When we look at firms, on the other hand, we see that the reaction per tweet is much more muted, right? So the highest that they get is about a little less than 0.05%, right? And so this is saying that the tweets that executives post are actually significantly more strongly reacted to than those of their firms, right? And that's why we have this stat here that actually executives' tweets attract 583% more stock movement per tweet than firms' own tweets. However, of course, firms do tweet more often than executives, right? So when we look at the aggregate amount of impact that these two different channels have on the market, we actually see executives have a little bit more than 50% of the share of stock market movement coming from Twitter. But that means that actually in aggregate, the managers are slightly more important than the firm's accounts themselves. Right, so I think this is important to note that while we usually think of the firm as being the primary dissemination channel, the market actually thinks of the executives as seemingly just as important as the firm. Lastly, we take a look at what the mechanism is for this. Right, so here we're going to use this construct of similarity. And this similarity measure is the similarity between an executive's tweet and all of the tweets of their firm in the previous week. And we simply take the maximum of that similarity. Meaning we're trying to see, does this executive's tweet have any new information or not? Right? If there's new information, the tweet similarity should be very low. Whereas if the tweet is something very similar to something else the firm's already posted, the similarity would be quite high. And then the idea is that if the similarity leads to there gets a positive coefficient, and the regression meaning higher similarity leads to more impact on the stock price, then we would say that trust appears to be the mechanism because it's coming from tweets where there is little information. On the other hand, if we see a negative coefficient, that would imply that the mechanism is information. When we look at the regression, we do see here, right, that the coefficient is positive and statistically significant. And this regression is quite well controlled for. You see we have firm fixed effects, second fixed effects, year fixed effects, month fixed effects, and a bunch of controls. So the result itself is actually quite robust. And it appears that the mechanism is indeed trust rather than information. Lastly, I want to talk a little bit about the methodology behind how we measure this similarity. Now here we're using introducing a new measure into the literature based on Universal Sentence Encoder from Sir et al. 2018. This is a way of looking at the content-wise similarity of snippets of text on the length of sentences to paragraphs. So in this case, we can actually take a tweet and we can give the whole tweet to the algorithm at once, and it computes the meaning based on that entire object rather than just based on the individual words. As you can see here in this diagram, right, we would essentially take one executive tweet in blue here, we'll take all the firm's tweets here in gray, and we'll just ask it, okay, which is the closest tweet out of all of those? We use R and N to do that efficiently. We'd pick out the green one here as the closest one, and then that will become our similarity score for that tweet. On the next slide, I'll show you guys an example of just how well this algorithm can abstract away from word choice. So here I have a set of sentences that have asked a universal sentence encoder to rank the similarity between. So here, the first three are all quite related. What's up, how are you feeling, and how are you? And the last three we have, how old are you, how old are you in years, and what is your age? Right, so we can very easily see that the first three are related, the second set of three are related, but there's no overlap within these. Now what's interesting is that the methodology is actually extremely robust to abstracting away from word choice. So for instance, we can take the second one here, how are you feeling? Right, and we can also look at how old are you? Right, what we see there is 3 out of 4 words in both these sentences are shared. So if we think about the typical methods that we might use in accounting, like cosine similarity, we'd say that these sentences are practically identical, right? 75% shared, that's actually really high overlap, and so these must be the same thing. When we ask use, however, it says, there's actually very little similarity here, right? That's because it's not relying on the words themselves in order to actually classify this, but it's relying on the word order and what these words mean when they're put together. To take another example, we can also look at this first one here, what's up, versus how are you? Right, in that case, we see that there's not a single word shared. And because of that, right, we'd say, again, with something like cosine similarity, that these must be completely different sentences with no similarity whatsoever, right? When we ask Universal Sentence Encoder, we see that actually the similarity is quite high, right? And so in this case, we can see that it really isn't sensitive to word choice. And in fact, there can be no overlapping words at all, and it will still realize that these are actually essentially the same sentence. I hope you found this presentation to be informative. If you'd like to learn more about our paper, you can always tune in to the presentation and Q&A session that'll be held at 3:30 p.m. on August 12th. Besides that, if you want to learn more about the project, you're always welcome to drop by my website at rmc.link, and you can use the link in the poster above. Thanks for watching.